Okay, so this is the second recording, chapter 1. And here I have a question from your textbook from chapter 1. And this is an example that you can go back to chapter 1 and see this example there. So here we are going to learn how to prepare journal entries when there is an investor or investor that invested between 20 to 50% in another company, in an investee, and the investee has reported income and has also declared dividends. Okay? So remember, between 20 to 50, we usually use the equity method because we believe that the investor has the ability to significantly influence the investee's decisions, the company, that's what I mean by the investee, the corporation, that the investor owns 20 to 50% of that company. If it's below 20, then we will use the fair value method. Okay, so let's look here. Assume that big company purchased 20% interest in little company. So that happened on January 1st. Dates are extremely important in accounting. January 1st, 2023. The investor here is big company, and they purchased 20% of little company's common stocks. And they paid $10,000. Then the investee little company reported net income in and I've written the dates here, December 31st, 23, 24, and 25. And these are the amounts of net income, 200, 300, 400 in the next 3 years. And they declared dividends of $50,000, $100,000, and $200,000. Okay, so this is what I have about little company. Now, also the fair value of BIG's investment. Now remember that big company owns 20% of little company, okay? And the fair value of BIG's investment is 245,000, 282,000, 325,000 in 23, 24, 25, and 26. Why do I stress on the 20% here? Because this is not the fair market value of LC, of little company. This is the fair market value of only the 20% of what BC owns in LC. Let's read it again. The fair value of BIG's investment in little company as determined by market prices is. All right? So that's important to know that this is not the fair market value of LC stocks, but the fair market value of big company share in LCs. Maybe it's better to say investor and investee. Okay. So what is the question? Let me go back to the ebook and see what was the question. I think they said that we have to use, actually, I closed the book. Okay. To first use the fair market value method to account for what's happening. We know that the fair value should not be used here if the investor can exercise significant influence. But let's do the fair value just to differentiate between fair value and equity method. All right, so on January 1st, how much did we pay? We paid $210,000 here. The investor purchased 20% of the investee on January 1st for $210,000. So credit cash and debit investment in LC. Okay, so this is the first entry. And here I have the investment account, which is an asset, and there is a $210,000 in there. Now, the income that the investee has recognized in 23, 24, and 25 are not going to be used in the fair value method. We don't care about them. We care about the dividends and stock appreciations only. And the dividend is considered a revenue. So December 31st, we received a cash of, let's read again the dividends just to make sure that this is the question here. Is this LC's share of the dividend, or this is the dividend that, sorry, is this BC, or is this the investor's share of the dividend, or this is the investee's dividends declared? So is this 100% of the dividend, or this is 20% of the dividend? So little, where is that? Here. Declaring dividends of 1,500. So this is the dividend that the investee, that little company, declared. But the investor will only receive 20% of the 50,000 because that's how much they own. Which is 10,000 in 23, and 20,000 in 24, and 40,000 in 25. So debit cash and credit dividend revenue, same thing for 24, same thing for 25. Notice that under the fair value method, dividends received is considered dividend revenue. And this is the total revenue of 70,000, okay? So now, one, if you recall from my previous recording, the cost or the purchase of the stocks, and two is the dividend transaction, and the third transaction is the change in value, appreciation, increasing the value of the investment if the fair market value of the stock goes above 210,000, and decrease the value of the investment if the fair market value of the investment went down. So again, this is here the investor's share, okay? The fair market value or the fair value of BIG's investment in LC. So it was 210, now it's 245. So 245 minus 210, there is an increase in 35,000. There is an entry here to debit investment in LC 35,000 and credit unrealized holding gain. Now, how much we have here? Let's see the total value in the investment is 245,000, which is 210 plus 35. But the fair market value is 282. So it's going up. The stock value is going up by 37,000. Debit, investment in little company, and credit, unrealized holding gain. Now we have 282,000 in the investment in LC, but at the end of 25, the value of this big share, okay, in the market price or the market price of these shares went up to 325,000. So it was 282, went up to 325, 43,000. Same entry, debit, investment in LC, and credit, unrealized holding gain. Okay, and that is $325,000 value of BIG's investment in LC, and that's the difference. We usually do not use the equity method, the fair value method, when we own between 20 to 50% of the investees' stocks. We use the equity, okay? So let's look here at the equity method. Same exact data. The first entry is to record the investment at cost, which is how much I paid. I paid 210, and this is the investment account, okay? So now it has 210, let's not actually roll this, $10,000 as initial investment. Now, under the equity method, when the investee recognizes income, my investment in the investee will go up. I will also recognize income, but only for my share, which is the 20%. So here, December 31st, 23, the investee recognized $200,000 in income. Well, I get to share 20% of that, which is $40,000. My investment in LC will go up when LC or when the investee has reports net income. And the credit is equity in investee income. I have equity. I'm entitled to 20% of that income. So my investment will increase. And I added the 40,000 here, okay? Now, I also received in 23, I also received $10,000 dividend, but under the equity method, this dividend is not considered a revenue. This dividend will reduce my investment in the investee. So debit cash and credit investment in LC, $10,000. So why the dividends under the equity method is not considered income? You really need to think here. You really need to understand what is net income and what is retained earnings, to be able to understand and what is the impact of dividends on retained earnings, and where is dividends coming out from. All right, so if you recall, when a company has net income at the end of the year, the net income is closed into retained earnings. Yes? So I have recognized $40,000 net income, which is my share from the $200,000 income that LC recognized. My share is 40. That's the net income, yes? Now the $200,000 for LC is going to LC's retained earnings, yes? In the $200,000, the dividend is there. Now, this 200,000 is in retained earnings. And now LC is taking 50,000 out of the 200,000 to pay the dividends, okay? So what is LC doing with its equity? LC is reducing the equity because when LC pays dividends, return earning goes down, and return earning is part of stockholders' equity. And I have to do exactly what LC is doing. When LC recognizes net income, I recognize net income and I increase my investment. When LC pays dividend, LC is going to reduce their stockholders' equity. I'm also going to reduce my investment in LC because of that. I cannot report income of 40,000 and income of 10,000 for the dividends, because if I do that, then the 10,000 is already in the 40 because it's in the net income, because the 50,000 is in the 200, okay? So that's why dividends are paid out of income, and income is already here, so I can't say that this 10,000 is also in under the equity method. Okay, remember, under the equity method, whatever the investee is doing, I'm going to do the same. Investee recognize income, I will recognize income. How? I will increase my investment. Investee recognizes loss, I will recognize loss. How? I will reduce my investment. Investee paid dividends, that's a reduction to stockholders' equity. I will reduce my investment in LC. Okay, perfect. So this is the $10,000 here for dividends, and this is the 40,000 for the gain. Okay. And then in 24, there is a $300,000 of income that LC declared or earned, and I will get to share 20% of that, which is 60,000. My investment in LC goes up, equity in investees income. Okay, so this is the equity in investees income. This is my share of LC's income. And now the dividends, debit cash, and dividends reduce the investment in LC's account. And same thing with the 2025 transaction. So notice here that the investment in LC account is different under the equity method when compared to the fair value method. Under the equity method, the income reported by the investee, we get to increase the investment, our investment as investors, by our share of that net income. And the dividends that the investee declares, our share of that dividend reduces our investment. Notice that we don't do the valuation of our stocks at fair market value like we did here. We don't do this because this is not the fair value method. We don't care about the fair values of the stocks at the end of each year. And the equity in the investee's income went down by all the dividends, okay? Which is 180,000. Sorry, I just made a mistake here. The equity in investing, the dividends reduce the investment in income. This is the dividends. Okay, I should not be recording. This is late. The dividends reduce the investment in LC. LC is little company. LC is the investee. Okay, so again, dividends reduces my investment and income increases my investment. All right, this one here is the income, the equity in investee's income. This is my share of the income of the investee, which is $180,000. Okay. Perfect. So that is the difference between the fair value method and the equity method. Notice that in the fair value method, the dividends was considered dividend revenue. In the equity method, the dividends reduce my investment. Notice that we both invest the fair value method and the equity method recorded that initial acquisition or investment entry the same, but then in the fair value method, we kept updating the value of the shares to match the market. We did not do this in the equity method. We updated the investment account every time the investee had income or loss, and every time the investee declared dividends. What if the investee has a loss? Then it's the opposite to this. Investment in LC will go down and equity in investee income will investment will be debited because it's a loss. A loss is a debit and the investment is an asset. To bring it down, you will credit it. Okay, perfect. Now let's look at this question here. Actually, I'm going to stop the recording to keep it short, and we will start another recording.